Hi, Gary here. You know, in December, Ben Bernanke and the Federal Reserve Board agreed to cut back $10 billion a month starting here in January of bond buying back. In other words, starting to taper back on the bond buying program. This is something we've all been waiting for a long time, which basically means the Fed thinks that the economy is moving forward. Well, so, you know, what does this have to do with you and me? Well, take a look at this chart. What you're seeing here is long-term interest rates, 30-year U.S. government bonds. Back in 1981, they issued one for 14.75%. And over the next 31 years, until the summer of 2012, those rates went down to 2.5%. Now, that's huge. That's called a bull market in bonds. Now, you're looking at this chart and you see this long downhill thing. So what's the probability, just from common sense, that it's going to go up? Probably fairly high. Interest rates are going to move back up. So let's make this real simple. When interest rates move up, you have a bear market in bonds. We have not experienced this, any of us, in over 30-something years. Actually, much longer than the last time was way back to the 60s. So this is something that none of us has really any experience with. But it's a huge issue right now because it's really going to change direction and move the other way. So what does this look like in the short term? Well, in the short term, if you think about it, a 1% interest rate rise on the second chart shows you that if you owned a 30-year Treasury, the value goes down by 19%. And a 10-year Treasury, it goes down by about 9%. So you might be saying to yourself, well, you know, I bought a Treasury for 3%, 10 years. Let's say it's what the rate is about now. And I'll just hold it for 10 years. Well, that's easy to say because you will get your whole value back over 10 years. But in the meantime, if that 10-year bond rate goes to 5 or 6%, you're missing out on 2 or 3%. And I have to say, if you bought a $100,000 bond portfolio of these, you're looking at $2,000 a year every year, $3,000 a year every year for 8 or 9 years. You're not a happy camper. So it's probably good to try to avoid this if you can. So what we're talking about here is this real transition that's taking place in the bond market. It's strategic, not tactical. We're talking about really changing the portfolios that we have relative to debt, to fixed income part. I'm not talking about the stock market now because you probably have plenty of exposure there and you don't want more exposure there because that's even more volatile than the bond market. But we're talking about now the bond market, strategically what you do. Well, there's other areas to go into. What might those be? Well, alternatives like floating rate, there's mortgage-backed securities, there's high-yield bonds, there's emerging and international market debt bonds that you can use, and many others. And you might be asking, why would you consider those? Well, the interest rate rising environment we're probably going into here for a while doesn't affect these as much as it does these long treasuries or AAA-rated corporate bonds that have a long maturity rate. There's not much as an effect on this. And you do want part of your portfolio to be in these what we call debt instruments to protect yourself in case we have a big stock market downturn. This is a place of safety. So it's very important. So this transition is happening right now. And one of the things you want to take a look at is to see if you're positioned correctly, strategically, to make sure you take advantage of what is coming down the line. Now, it's just a matter of sitting down with financial counsel and going through your overall portfolio to see if you have any of these very interest rate sensitive types of debt instruments out there that will have a very negative effect if interest rates continue to go up. And that's what most believe will happen over the next several years. So the bottom line is, take a look at the portfolio. If you already have and you got it positioned correctly, great. If not, seek counsel to help you with that. So until next time, enjoy.